I'm already thirsty, so if you don't hit it, I'm gonna crack.
We're recording. Sorry. All right, here we go. Leave all that in. Hit it.
It's Friday, March 28th, 2025, episode 261. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the great pleasure to welcome to the show Julian Brigden of MI2 Partners. We have a fantastic discussion about the importance of the macro environment right now. And Julian explains why it's so important to not apply old playbooks to today's trading. And then we have Patrick in his big box of crayons and talking charts.
And folks, we might even drink some beers along the way. Danny, hop on. What beer am I drinking today? Because none of you guys...
Well, today, finally, we've got a beer to review. This is the Junction Hazy IPA. Apparently, it has flavors of peach, toffee, and hops with a hint of cut grass and herb. Would you say
cut grass?
I definitely got a mouth. I got a mouth of cut grass. It's it just bam. It just
lawnmower straight away.
Listen, a quick announcement. With the markets rolling over again, I felt it was important, a big picture, to bring back the special webinar we've done on hedging strategies. It's going to be on Tuesday, April 1st at 4 p.m. Those of you that want a deeper dive into portfolio protection, register at our bigpicturetrading.com website. Kev?
All right.
Let's do some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the tariff tension tremors, the resistance rejection rash, and the liquidity loss lesions.
I've got lesions and rashes everywhere, buddy. So it's out of hand.
All right, let's get to the interview with Julian. It's our great pleasure to welcome to the show Julian Brigden, the founder of MI2 Partners. Julian, thanks for coming on. I'm catching you.
You were quicker. Yeah, you were quicker than I thought you would be. Sorry about that. Thank you very much for having me.
It's a real pleasure. And I was laughing with you earlier. I was saying that a lot of our views are going to overlap. So they'll be nice to hear someone else say it, apart from me saying all those things. But before we get to your very kind of controversial, fun views that you're going to share with us, let's get to know you a little bit more. Let's go through your background. If I got the accent right, you're from the UK. You grew up there.
Right.
And
Yep.
Well, did you always think you were going to end up here, or what was the path to get to this point?
I always liked American girls. Joking aside, actually, I did always like American girls. But I've always worked in my early career, I always worked for US investment banks.
Okay.
And they were just the most dynamic, exciting places to be in the late 80s, early 90s. They paid the best. That was important. That's kind of. So
did you go to school? Did you go to school in England,
I went to school in the UK and university in the UK and West Germany, as it was known back then.
Okay.
Once again, dating myself.
Wait, so you went to a school in Germany that was before 1989. So when it was actually the wall had not come down yet.
Correct.
Okay, so tell me about that before we get into it. I'd love to kind of get your experience. What made you go there? Like, what did you take? What school was it?
It was, at the height of sort of, pre-Brexit, obviously, there was a study program that had just been launched by the EU to sort of foster relations, call it what you will. But it was a program where they supported and encouraged countries to develop these integrated study programs.
Okay.
And so I went as a young, 19-year-old, sorry, kid. And the program, there were 4 countries. So there was the UK, Spain, Germany, and France.
Right.
And the idea is you picked one as a Brit, and then you spent 2 years in that country, 2 years in your own country. The whole thing was fully integrated. So I took my finals. I went from sort of second year accounting in English to third year accounting in German.
Wow.
And came out of it with a fully integrated, I've got my BA honors and the equivalent German degree.
What year was that? So what year were you in?
So
Germany?
those were, I graduated in, so I took a year out. So I graduated when I was 23. So that puts me at 87, 88.
Oh, okay. So the wall was like, there were start to be chinks in the wall, but it was still fully up. So were
Right.
you in Berlin or was it somewhere in West
No,
Germany?
we were actually just south of Stuttgart.
Okay.
And but I went to Berlin, pre the war, coming down, and it was a surreal experience because if you're in Germany, you wouldn't fly in, you'd train in,
Oh, really?
or you could drive in. But I was a student, so I trained in, and you went through essentially a corridor that went from West Germany. Berlin was in smack in the middle of Eastern Germany,
Right.
and surrounded on all sides by the forces of the communist or the USSR, right? And so, you would. I remember.
Like, would you go through checkpoints, or would
the way that it worked on the train was that you would, and I did this with my father. We went to an electronics exhibit. My dad was in the electronics space, and he wanted me to go and help him translate. And so we caught the train in Frankfurt. We got on in the evening. We woke up in the morning, or we were woken up, let me say, in the morning by the East German border guards. And we were in a cabin, with beds. And I had this Alsatian, leering at me with an East German border guard with a machine pistol pointing at me, demanding Ausweis bitte, right? But actually, I don't even think he said please. I think it was just Ausweis. And they checked all your paperwork on the train, and then you just arrived in Berlin Bahnhof, and then you were sort of in this oasis. And in those days, Berlin was kind of a strange place because it was a great place. It was a really fun place with a vibrant energy and I couldn't quite describe it because the Germans were quite conservative and Berlin was quite the opposite, right? It was quite the opposite. I mean, I'm sure, you've seen in programs or read stories about how liberal and accepting sort of Berlin was in the 30s, but it kind of was even in the 80s. And I think a lot had to do with this concept that really you were 2 minutes away from just getting rolled over by Russian tanks.
Right.
So you just live life to the full.
Wow. That's a great story. Okay. So you graduate from this, and is this the point where you get your American job and do you move overseas?
No. So I did an internship before I actually started the program. I took midway through the program, I took a year out and went to go and work for a company called Fibro, which was a commodity
Salmon
trading house, which subsequently became Salomon Brothers.
Yeah.
So I was the junior on the precious metals trading book.
Ah.
So I did that for a year, went back to uni, parried that into an internship for Credit Suisse in Zurich, trading precious metals, running their precious metals options book for silver, which is, I remember selling an option at 110% vol. Because that's what the stuff was moving around that much.
Yeah.
So then finished off uni, went back to the UK, got a job working for all my sins Drexel Burnham on the FX desk. Went from Drexel Burnham to HSBC into FX sales. That's when I switched over to the sales side. Went to FX sales, stayed there for a few years. Left there, went to Lehman Brothers on the FX sales. Ended up running FX sales in London and then FX sales in New York. Then got offered a job to run global hedge fund sales for UBS.
Right.
Just before the merger with SBC. Obviously was on the wrong side of that trade when they walked in with the sides and you were and the welly boots and you were in the sheep's outfit. You knew which way that trade was going to go. Then went and worked on the policy side for a group called Medley Global Advisors.
All right.
I was a bit sort of tired. I had my stock. I was fine. Had my
Actually,
house paid
before
for.
you continue, I'd love to know a little bit more about Medley because I remember in the day, Medley was the beans, man. Like we would do, it was a group that moved markets. I would love just kind of, why don't you tell people about Medley was, how they were so influential. I would just love a little color of that stage of your life.
So Medley Global Advisors was the premier policy think tank on the street. And the MO was pretty simple. We would go in and see policymakers, central banks, finance guys, and we would read the tea leaves and we would share with them the market's views of the world. You'd be surprised how poorly informed they are when it comes to markets, right? They don't spend their time. The Fed will reach out by the New York Fed desk or give them a sort of a view. But these guys are, mostly academics by training,
right?
And they don't always understand markets. And we set it up so that we had sort of a very sort of bifurcated kind of approach. So we had the market people that were like me, the sort of spivvy, as they would say, the shiny suit brigade, that are sort of untrustworthy market people. And then we had a bunch of very, very experienced journalists who were much more disarming, could talk to the policymakers in the right way, and so on and so forth. So we would go in and see these guys. Back in those days, you're talking sort of Alan Greenspan and the likes. And we would read the tea leaves, and then we'd come out and sell it to our clients for an inordinate quantity of money. Inordinate. Like the base subscription was $250,000 a year.
Wow. I remember, because every now and then you'd get some third-hand Medley report, and it was always so insightful, and you'd be like, whoa, these guys, and it would be passed around for a month. So by the time, I got it and saw it was all fully baked in the market. But if you could get at the front of the line and learning what Medley was saying, you guys were moving markets.
Oh, I mean, I remember, in the days of dollar yen intervention, Richard got a call from, may he rest in peace, Richard got a call from Sakaki Baru at the low in dollar yen.
Yeah.
And the conversation was, we're about to intervene. You've got half an hour.
Really?
Yeah.
Wow. So that's worth a lot. No wonder you're getting
it's worth a lot.
Yeah.
It's worth a lot. It's worth a lot.
The 250 was underpriced.
Yeah. Yeah.
Oh, that's wild. Okay. So from Medley, what do you do? And just kind of get us to the last.
Then, I got married to an investment banker, and all my friends said, you've got this great life. She makes all the money. You're the smartest man at the cocktail party. I hate to tell you, when you have kids, you won't want to do that anymore. You better get your ass back onto the street. So I went back and worked for all my sins at French bank, because a friend of mine was setting up a business there. So I went and worked for that, once again in FX. And then I had a bunch of really good clients, because obviously I'd had these relationships at Medley, talking to the principals of the biggest macro hedge funds on the planet. That was kind of my client base. And when I went back to the sell side, I started to write my own commentary, and as a way of sort of keeping them interested and enticing. Got lucky with a few things, saw the global financial crisis coming through, got lots of clients, very long dollars, because I was, still very focused, and other things. So got that call right going into the GFC. And then basically in 2011, one of my clients said to me, quote, I can't do enough business with that shitty French bank that you're at to pay you for the information and the ideas you give us. Here's a check, go and set up your own business.
Oh, that was very nice of the guy. That's a great story. All right, let's talk about markets. I don't know, where do we start? You're kind of a vocal bear on the US dollar and the US stock market. Why don't you walk us through why you feel that this is such a pivotal point in history in terms of macro?
So before we get onto the sort of tariff situation, I think it's very important to understand, I think, the structural setup that we've enjoyed in the US. It's not the first time that we've been in this situation. I mean, the US, as the reserve provider, tends to get into these positions where money naturally is attracted. I mean, that's, we are the PAX provider, to use the true technical sort of term. the pact system being something that we've seen operating throughout history. From the Roman Empire onwards, we've seen 7 pact systems. Most people, as I said, are sort of familiar with Pax Romana, the Roman one, Pax Britannia, the British one, and now we're definitely in Pax Americana. And so there's a the way that system works, and obviously we're a much more benevolent one than, say, the Roman Empire was, where these things were imposed via force. Ours is imposed via trust, or exists via trust. And that is kind of a system where the US has crafted a world in its image where American rules of law and companies and cultural values tend to be dominant. And we reinforce those via offering protection to our allies. And their side of the bargain is that they're supposed to fund our excesses, in terms of, because as part of the process, we have to provide reserves to the rest of the world. And typically you do that by running large current account, large budget deficits, which is probably why none of these systems has survived history, right? We've no PAX has ever survived. So I think it's important to understand that is kind of the system. We have this sort of symbiotic, it's clearly not necessarily working for the US, judging by the recent election, and I think there's that's a fair assessment. But this has been a very symbiotic system for the US. The US has benefited greatly from being the reserve provider. It subsidizes our borrowing. It enables us to borrow large amounts. It enables us to live well beyond our means, which we are certainly doing. And most recently, I think, but it tends to cause these periods of excess, and because there's this natural flow that comes into dollars. So I think one of the things that we've been talking to our clients for really the last year, but particularly in the last 6 months, is the nature of this sort of cycle that we find ourselves in, and the interaction between flows, the asset markets in the US, and the US economy, whereby we're quite concerned that we're in a truly reflexive cycle. In other words, one that is, in the purchase of the asset, you underpin the fundamentals that justify the price of the asset. And if that's correct, and this is what, this is thesis that I sure as heck didn't come up with, probably the best macro, or one of the best macro investors of our era did, George Soros, this is a far from equilibrium state. So basically, we think this started really with a vengeance in 2014, maybe in 2011, but it's easy to explain from 2014. If you remember, back then the Fed was starting to sort of tighten policy, just as the ECB and the BOJ and a lot of other global central banks were moving into negative interest rates. And this causes this wave of cash to come into the United States. You see it in the price action of the relative performance of US assets and also the dollar. So money piles up into the dollar. That money looks for a home. It starts to buy US corporate debt. The corporations start to buy stock as they're issuing more and more debt. The stock market starts to outperform. As the stock market starts to outperform, it creates kind of 3 economic effects. Firstly, a huge wealth effect, which stimulates consumption. It's reached an extreme whereby the top 10% now are responsible for basically 50% of all consumption in the US, and that's built upon wealth. The second thing it does is, as stock prices rise, CEOs become increasingly confident, and they hire more people. You can actually draw a chart where you can look at how stock prices lead employment in the US by 6 months. And that in itself underpins consumption. And then thirdly, it tends to cause a very large current account deficit because we overspend. And that demands more foreign funding, because the current account deficit, to enable you to go and buy that Japanese car or that German car, has to be funded in euros or yen. And so how do we get them sitting here in the US? Well, we get them by either borrowing them, or what we've actually done is we've sold assets to them. So we've essentially, this is the analogy I use, Europeans have been bitching about all these influencers, these US sort of millennial influencers going off to Santorini and buggering it up for everyone by taking this sort of picture standing on the cliff, all 500 of them at once. And to fund that, we've basically been selling the family silver. We've been selling NVIDIA shares. I'm not sure I call treasuries the family silver, Quite the opposite. I'm not a big fan of those, but you get the idea. So over the last decade, as a result of these inflows, what's referred to as the net international investment position of the US, so the difference between the assets that Americans own here overseas versus the assets that foreigners own in the US, has risen, or in the case of the US, declined by $17 trillion.
Wow.
So foreigners have bought a net $17 trillion of assets in the US versus what Americans have bought overseas. Now, that is fine. And maybe conceptually that can keep going. I think we're kind of pushing our luck a little bit. Bridgewater did some work that said now that of every dollar globally that's saved to go into the equity market, 70 cents has to go into the US just to keep the relative differentials where they are.
Right.
I think we're kind of pushing our luck, all right, in terms of that assumption. But it is, my concern, as I said, is this is inherently fragile because a lot of this $17 trillion has come in on an un-FX hedged basis to enable us to import all those goods.
Right.
So a lot of it's gone into assets, and those assets have fed the economic strength. So I think this is essentially a three-legged stool.
All right.
It looks stable, but to use Soros's terms to describe a reflexive cycle, it is far from equilibrium. Sorry, he said that. And the reason is in the US case, if the dollar were to fall, right, which it has done recently,
right,
foreigners lose money on their investments. In fact, if you're a European investor unhedged in the S&P, in 3 weeks recently, you lost 15% of your money.
Right.
Right? So if the dollar falls, Mr. and Mrs. Schmidt, Mr. and Mrs. Watanabe will take their money home, right? Number one risk for the dollar. Second risk is if somehow we wake up one day and we decide we don't want to buy AI because maybe, we just realize we've paid too much for it, or there's been an overbuild, or, like the chairman of Baidu came out and said, maybe we got a bubble, right?
Right.
And what we really want to buy are Aussie and Brazilian mining stocks, right? So if the money goes home, the cycle reverses. And the third thing is, if in the process of Doge or correction in the equity market, we get a recession, the current account deficit will collapse, we'll stop spending as much money, and we won't need that foreign money, and the money will go home. Right. And I'm very concerned that if that were to happen, this becomes turns from the virtuous cycle, right, the virtuous reflexive cycle, to a vicious reflexive cycle,
right,
whereby the dollar is falling, foreigners are taking their money out, US assets are underperforming. As US assets underperform, companies are cutting employment, the wealth effect is falling, right? And you can see how this turns to this. And I do not believe that it'll be easy to stop. You throw on what we're doing with our allies in terms of Pax Americana, and we're destroying fundamentally the trust that underpins that. I mean, you could call it the art of the negotiation. And I'm not trying to say whether this is right. I really want to stress this to people. My job is not to make a decision as to whether one political decision versus another is right.
Yeah.
My job is simply to figure out the consequences. And I vehemently believe that if people believe this will be a painful process for the US, and that they vehemently believe that, and they might be right, that ultimately we may be better off from this, I don't have to care about that because I think it's so far out from a market perspective that all I need to be focused on are the immediate consequences. And the immediate consequences, I think, are going to be bloody disastrous.
Okay. Let me jump in here in terms of, I would love to get your take on the idea that if we kind of back up a month or two ago, and I don't know if you experienced the same thing talking to your clients, but when I went and spoke to American investors, they were so bullish on the market. There was this just Trump is going to make everything great. He's going to deregulate. Stanley Druckenmiller said this is the most business-friendly administration he's seen in decades. You had a very famous strategist going around saying he's never been more bullish than at the current time. There was Bill Ackman saying that this was, on the day after Trump was elected, it was about to unleash the golden age of America. What did they get wrong? And do you think that was the peak in, dare I say, American exceptionalism, or at least the belief in American exceptionalism?
So firstly, I really hate that term. Nothing personal, but I hate it. I don't think spending like a drunken sailor is exceptional. Okay. There are some exceptional companies, but we've been funded by excess spending and debt. That's not exceptional.
So can I just want to ask a little more in terms of that. So when you're saying you hate that term, and that you're saying that really the reason for the American exceptionalism in terms of the stock performance is the deficits that we've been running.
And that reflexive cycle that I talked about, right? Foreigners have funded it to the tune of $17 trillion of inflows.
Right.
So to go back to your sort of original question, why did people get it wrong? So on the day of the election, as we were waiting for the results, I wrote a piece called Election Breaking Eggs.
Okay.
And I said that the assumption, and I'll read it now because I'm writing something for next week. The assumption that Trump is equity friendly and a reckless spender is at best simplistic and worst simply wrong. Investors are underestimating the reformist zeal of the Trump White House that it would be determined to deliver on a promise to better the lot of working men and women in America, not Wall Street or the C-suite.
Okay.
Thus, tariffs will be introduced with full force early in the presidency, which at least initially doesn't look market friendly. So, through my policy contacts in 2016, I was told that the Trump tax bill, what subsequently became known as the TCJA, was at least initially introduced in Congress as a very conditional tax bill with very purposeful objectives. The objective was to tap into that pool, an amorphous pool of offshore profits that, Microsoft and everyone keeps in Ireland or Liechtenstein or wherever the hell it is, right? And avoids paying US tax, and entice that money to come home, build plant and machinery, hire people in the United States. And if you did that, you were going to get a tax cut, because Trump was tying into this visceral, popularist, arguably correct, disenfranchised, or felt like they were disenfranchised, core of America who thought that they had been screwed by globalization. And they had.
Right.
Okay. And they have. So we just said, this is what he's going to do. And then what, of course, happened is it went to Congress. The lobbyists got their sticky little mitts all over it. And it became, all the conditionality was removed, and it became a tax cut for you, and a tax cut for you, and a tax cut for you. So the perception as that resultant massive tax cut rolled through the corporate sector was Trump is just a good time boy, and all he cares about is a high end equity market. And I think and I was told by my friends in DC who were either working very closely with the administration or working in the administration, that was not the objective. They went along with it because they weren't ready to take power to begin with, right? So fast forward 8 years.
Okay.
And they have a plan. And this plan is far less carrot. It is much more stick. And the stick is tariffs. And the stick is designed to, quote from one of my friends in the policy space, build a tariff wall to make it uneconomic to produce goods abroad and import them into the United States.
Okay.
And it's that simple. But that is a lofty ambition. And I'm not saying it's right or wrong. right? I think if you're sitting in the Midwest and, you know, your father lost his job in manufacturing and there's not a ton for you to do there, and, you know, you're sitting in a town where fentanyl and crystal meth is a problem, which we know is a vein that the president has tapped into. I think all of these are highly laudable objectives. The process of which you get there is not smooth, where you have a system where you've optimized it to a globalized system, where you've optimized it, the C-suite has optimized it to benefit themselves and Wall Street and to screw American workers. They are arguably the criminals in this, right? We all blame. I love how the politicians like to point the finger at China and Mexico and say they're the problem.
Right.
No, they're the recipients of a decision that was made in the C-suite.
Right. Yes.
Right. So this is why when you get someone like Scott Bessent say Wall Street's done fine, right? What he really means is you've made out like bandits. And in the process, you've screwed the rest of the country.
Right.
Now, the good news is they're a capitalist, so they kind of want the pie to grow.
Right.
But going forward, they want much more of that pie to go to Main Street and not Wall Street.
So one of the things that I find interesting is that how some in the markets convince themselves that we can have both. We can have all this manufacturing coming back to America, and also the premium upon which people price our stock or the American stocks at staying elevated. And that's always my point. You can have one or the other. You can't have both, because the stock market has been, as you rightfully point out, the recipient of this globalization. They've been the best at taking advantage of it. And if you take that away, then the premium comes off.
Yeah.
Am I wrong? Like, can you have both?
Right. If the trade deficit disappears, then foreigners won't have the dollars to recycle back into US assets.
Right.
And let's not, before we even start, that the administration wants a significantly weaker dollar, right? And the dollar is very expensive by historical standards, right? And so when you look, I mean, this is counterintuitive. You know, I think, you know, most people would say, well, you know, and you hear it on CNBC, you know, I'm not a great fan of some of the quality of the people on there. I have a little GIF where I have a Wall Street banker with a tutu on, pretending he's a cheerleader, and that's, I think, essentially what they are.
Right.
But you know, a lot of people say, well, you know, a weak dollar was good for corporate earnings. Okay, but really, what determines relative price performance, certainly from a US investor, are currency trends. And when the dollar is weak, US stocks underperform the rest of the world.
Right.
And they have outperformed because the dollar has been strong, because essentially you've been offering foreigners a two-fuzz. They've made out on the currency, and they've made out on the outperformance of the US equity market. So if you look off the lows of 2009 in euro terms, the US equity market went from 1,000 to 6,000. Right? I mean, because the euro's gone down too.
Right. Could you talk a little bit about how much the foreign investors are overweight the U.S.? Because one of my kind of themes that I keep having is that, sure, you know, we've had the DAX run, we've had people for a little bit selling U.S. stocks and buying, you know, European stocks or wherever. But this is a trend that has lasted for a long, long time. And this isn't something that is going to be fixed in 1 or 2 quarters. It's going to be 5 or 10 years. And so just kind of give us some color about how overweight you think the world is of U.S. assets.
Well, as I said, I think, you know, 70 cents of every dollar that goes into equity markets globally has to come to the US, or has been coming to the US. So that suggests, since the US is not 70% of global GDP, that does suggest that, you know, a little over hyped, to say the least. I think there's also been some mechanical things that have encouraged overweightness. You know, a lot of talk within my space about how global portfolios, right? So, if you sit in Europe and you put your money into sort of a global equity fund, right, have become overweight of US tech stocks and the Mag 7 in particular, because, they derive 30 to 40% of their earnings overseas. So in that sense, they're truly global companies. The other thing that's been very good up until very recently is that, and this was an argument that was put to me by an equity PM, portfolio manager, was this idea that we could be even more overweight these US names, because the typical price action was, if we ever got a risk-off event, right? Remember, this is a European or UK fund, right? If we got a risk-off event and let's say Google went down, the losses were cushioned because the dollar typically goes up in a risk-off environment. So yes, I lost 20% on my Google, but I gained 5% in sterling terms on the move in the dollar. So I was better off. I could own even more Google up until this year.
It was like risk parity for stocks and bonds, but yet for foreign currency, for foreign holders.
Correct. So I think it's very hard to put numbers on it, right? But there's no question that the rest of the world is uber overweight US assets, and Europe in particular has been a big funder via the equity space. You can see that from the TIX data and some of the other flow data that we collect. And then the other question to ask yourself is, and I think this is much more extreme, is when you look at a balanced portfolio in the US, within the equity space, the historical mix was 65 domestic, 35 overseas. And I think when you look at that, it's much easier because you can ask RIAs and people like this, what are those sort of numbers? And I would say we're probably 95%
Wow.
US stocks.
Wow. So the overweight is huge, and this move is just the first of a move that's going to last a long time.
Look, to your point, you can't correct a trend. I mean, if you look at, this is an interesting one. If your listeners want to go, or your viewers want to go and look at, say, the chart of the FEZ, which is the Euro Stocks ETF in dollars. So you're taking out the currency effect, right? And you do it on a log basis versus the SPY. You will see that last month we blew through a very clear, defined trend line that had been in place for 18 years. Wow. 18 years where the US, on an FX equalized basis, had outperformed Euro stocks. And to your point, if this trend is reversing, right? Now, I know there'll be a lot of people listening here we're saying, but yeah, what are they going to buy? Why would they take their money home? Well, maybe because the Europeans offer a great, tax incentivized deal to buy European defense bonds, right? Maybe because when you have the Prime Minister of Canada suggesting that the relationship with the US will never go back to what it was, right? And the Canadian pension system has $1.6 trillion invested in the US, right? And the US and Canada no longer considers them a reliable partner, whether maybe Ontario Teachers or OMAs or who the heck it is, just decides that they're going to take down their 40% allocation to US and make it 30%, and the rest is going to go into Canadian startups because they need to start to rebuild their economy. The US essentially over the last 15 years has become the world's piggy bank, right? US equity markets are the piggy bank. Piggy banks are designed for, rainy days. And if you're sitting there in the rest of the world and what you thought was the post-war, Second World War sort of system built around a partner that you could totally rely on just got a hand grenade thrown into the middle, maybe you think it's bloody pouring.
Yeah, I think that piggy bank analogy is awesome. That's a great idea. Okay, let's go back to this idea that the U.S. is the world's piggy bank, but we all kind of know that there's no way that he's going to get the middle America jobs back as long as this relationship keeps coming. And I would love to get your thoughts in terms of the people in the administration. Are they purposely trying to break this relationship? And do they understand the risks that are involved in terms of changing the trade deficit? Like, do you think that Scott Bessent understands that a trade deficit to zero probably means lower stock market?
I know Scott.
Okay.
I know Scott understands that. Scott is a very deliberate thinker. Scott is a very thoughtful individual with an acute understanding of markets and history.
Okay.
However, Scott vehemently believes that the trajectory which we were on was ultimately unsustainable, and left to its own devices, we would have ended up with the empire crumbling anyway. That essentially, given the trajectory of the deficit, given the trajectory of the current account deficit, the fiscal and current account deficit, that we were going to end up essentially, to use the analogy, clipping the corner off the gold coin like the Romans did.
Okay.
Right?
Yep.
At which point, game up, game over, American assets are no longer money good, foreigners flee, China wins, we lose, right? Call that, get game over. The problem is there are no good choices now. So we are very much in a devil or the deep blue sea. If you say keep things going and pretend and extend, that would be the devil. The deep blue sea is not a painless choice. The deep blue sea is perhaps not a survivable choice. But versus the devil, it is the only logical choice.
Okay.
And I think they have decided, I think they believe that deregulation and forcing companies to build in the US will trigger a recovery at some point next year, probably. I'm a little more concerned because of how they've approached it and potentially the structural damage they're doing in that trust element with our allies.
Okay. Yep.
I think there are, look, don't get me wrong. I mean, I'm a big advocate of, the sense of the one element of the Mar-a-Lago Accord in terms of just getting the dollar low, right? It's very expensive, right?
Right.
We've seen policy intervention to push the dollar lower. It's a very standard, actually, Republican MO. Nixon did it. Reagan did it, right? Wasn't the end of the world. Everything ended up flowing back to the US. This time, I'm kind of concerned that we're taking things too far, right? We're taking things, and maybe we have to, because maybe it is true that we've reached that tipping point of kind of what is in the PAC system called imperial overreach, right? Maybe it is that we just simply cannot fund NATO anymore, right? Even if we wanted to. And I'm not saying that I totally believe that Europeans have been freewheeling on this one and they need to pay more. But maybe we just physically can't. If we've got to try and contain China, right? It's just too much money. We haven't got it. Our debt's already in a bad place. So we have to make a choice.
Okay.
And I think that's a reasonable decision to make. But we do need to understand that when the Europeans have been the provider of most of, as a region, of that inflow into the US equity market, and they need their money back, or they want it because they don't trust the US anymore, then that has consequences for our asset price, our asset markets.
And can you let that balloon out slowly, or is that what you're worried about?
When it depends on asset prices, they generally don't balloon out slowly. I mean, when you look at asset prices, they're very much the sort of up the escalator, out the window kind of price action. like down the lift shaft or whatever analogy.
I like the
you
window
use,
better.
right?
I like the window better. That's a good one.
That's the nature. I mean, selling begets selling, particularly in a market where everyone is unbelievably bloody long, where vol suppression funds have just crushed vol, where the world is used to. I mean, I've been trying to stress to clients over the last, new clients in particular, that we could be at a point in history, the like of which we certainly haven't seen in 40 years, but arguably haven't seen since the Second World War. And so this concept that everyone has got used to, that, and particularly younger trading members, right, that everything mean revert. So at 1 standard deviation from the mean, you start buying it. At 2, oh my God, you back up the truck. I think it's a very, very dangerous assumption if we are at a true inflection point in terms of the global system. And I think we are going to look back, maybe not you and I will be dead, but in someone who's in their 20s is going to look back and say in 20 years time or 30 years time, wow, did I miss that? That really was the event. And if you're trying to manage your portfolio, and particularly if you're in the US, which I think is going to be very hard to come out of this hole, these are very dangerous times.
Julian, it reminds me, I can't remember if it was Barton Biggs or maybe it was Byron Ween said something about, they asked him, what was it like in 1982? And he says, the problem about 1982 is that you didn't realize it was 1982 until 1985, meaning that it's only in hindsight that you become. And the other thing is, you mentioned the buying 2 sigma moves down. Another joke that we used to have on the desk is the problem with 3 sigma moves is that they never stop at 3. They always go to 6.
Well,
right?
we used to have, I mean, if you remember when I sat on an FX desk, you used to have these GTC orders.
Yeah.
Right. And that stood for good till cancelled.
Yeah.
And then we used to always call them good till close, because what would happen is someone would say, oh, I'm a buyer of dollar yen, 2 big figures below the market, until it got pretty close to that. And then they changed their mind.
No, you're spot on. One of the things that you mentioned is the fact that the US dollar weakness is an MO that's, Republicans have done it throughout the years. To me, I've been actually shocked at the lack of volatility in the foreign exchange market since Trump took into power. And I've been sitting there looking back at his Bloomberg Business Week article from the summer of last summer. And he said very clearly the Japanese yen was overvalued. He said very clearly that the renminbi was overvalued. And so far, we haven't seen any direct assaults on that. Do you think that is still coming, and what's stopping them from doing that so far?
No, I mean, I think, it could come. It could still come. It may not be necessary by the time they get their kind of act together. I mean, look, don't get me wrong. I mean, I think, we're talking about the Mar-a-Lago Accord piece that Stephen Mirren wrote, who's now within the administration, the National Economic Advisors chairman. Very, very thoughtful article. A bit long. I suggest anyone who wants to read it, just drop it into AI and get the summary. I mean, Stephen has what I think is very insightful about it is Stephen talks about the risks. He talks about the risks. So this is not, as I said, this is a devil or the deep blue sea moment. There are no good options left to the United States, right? There are no options that are good. I think when I look at this, I do think that we have got, we're at a point where I think uncertainty is max, and I just don't know how we get through this in the short term. I mean, I'm very, very worried right here. I'm very, very worried.
Okay. My next question was going to be, when I talk to the bulls, their kind of standard pushback is, Yeah. This is all Trump and the art of the deal. It's all him just trying to negotiate something for the tariffs. And they expect April 2nd will come. It will be less than everyone expects. It maybe even be almost zero. And then we're going to go back to the old environment. And my pushback is always like, no, there is no going back. And you highlighted what Mark Carney, our prime minister, said recently, that the relationship is forever changed. And this is something that I've been harking on, is that people just don't understand in terms of the threats to another country's sovereignty has made it so that we can't assume that it was just Trump with the art of the deal. These are lines that have been crossed that will forever change the world.
Correct.
And so therefore, I don't think it can turn around. I don't think the art of the deal will work here because these trends have been put in place. What do you say to the folks that say, this is just all a negotiation for the tariffs, and, come next week, everyone will realize that he didn't really mean it, and we'll be back to the races?
Look, as I said to you, I think people misread Trump in 2016. They misinterpreted what his objectives and who his constituency is. It is not Wall Street. It is not the 1%ers. This is a popularist party that is in the way, the antithesis of what I would recall, essentially call the champagne socialists who became dominant within the Democratic Party, right? And they've got this utterly wrong. I mean, the other thing that I would say is most of these people that you hear that sort of thing are those tutu pom-pom yielding, tutu wearing, cheerleaders whose job it is to keep the equity market pumped up, because that's how they make their money, right? That's how they make their money. They make money by gathering assets, and you get the most assets as the equity market rises, right? So they are not your advisors. They are not your friends. They are just cheerleaders. I think the second thing is that they don't understand what tariffs are designed to achieve. Yes, there is an element of the negotiation. I mean, it's interesting. I didn't realize you were Canadian, but I didn't realize that was a drug fentanyl kind of problem potentially in Canada, right? I listened to
it's overplayed. Like Scott Galloway said, the amount of fentanyl that's going across the border, you could put in a backpack.
Right. And that bit, the physical bit, I appreciate. What I think is not necessarily known is potentially how much, and it's a very interesting podcast that was put together by a Canadian about how much sort of drug money that can be in, that's come from Asia, that's stuck in, Toronto, sort of an Ottawa kind of property markets. Right. So I think,
we are definitely recycling, Chinese and money in terms of our real estate. There's no doubt about it.
Right. So I think, look, I think, but there is an element of the art of negotiation. So you could bring in a sort of, like anti-trafficking legislation, and you could start seizing assets, and that money would leave pretty quickly, right? If you started to clamp down on that. So, if they got that, then fine. That's the art of the negotiation. There's another element, which is that has to be a revenue raise, right? I mean, he wants to pass or roll over the TCJA, about $4.64 trillion cost. He wants to additionally put other tax cuts through. So we're at 6 to 7, right? You have a very, very, very narrow majority in Congress,
right,
where there's a bunch of true fiscal hawks, right, who said, I'm not voting for any of this stuff. Now, maybe he can browbeat these guys into something, but I fear that there's a couple of guys who would quite happily go down with the ship and stop him doing that. So he needs to raise money somehow. And one way to do it is the tariff. So we'd always worked on the premise, at least initially, that they were looking to raise, $2.5 trillion from the tariffs. That would be about, 20% on Chinese imports, which they've done, or you don't need to do or 8% on every import. And so I think that's a baseline. But it seems that they're going for significantly more than that. And the numbers that I'm hearing are mind-blowing. And so this is not a, strategic kind of precision bombing, sectoral, just cars, just, pharma, just, semis, right? I think on next week, on the 2nd, we are looking at something that looks like carpet bombing.
Wow.
And I do not believe that the market, and by the way, I'm really worried if countries start to retaliate, because then I think he could hit the nuke button. And I think in that situation, we'll be lucky if we don't have a crash.
Okay. So I have a question for you in terms of, to you, this is very clear that the people in power have a plan. They're headed this way. They understand the risk, but yet they're still willing to go do it because they think, as you say, that there's two bad choices. They're both bad and that they're headed this way. In all your years of trading, have you ever seen an environment where the macro is so obvious, yet the market is so oblivious?
Yeah, part of 08.
Oh, you feel it was that clear in 08?
I think it was very clear. I mean, certainly in the seat that I was sitting in at the time, I think it was very, I mean, like, I was lucky, one of my colleagues at Medley was the premier guy who ended up writing the book. A guy called Josh Rosner ended up writing the book with Gretchen Morgensen on the housing issues. And Josh and I would speak every single day, and I remember getting him on a call in early 08 with two massive hedge fund clients of mine, and the two principals of two of the biggest macro funds on the planet. And Josh spoke for an hour and a half, and I got one phone call back from one of them, and the guy said, and I won't use the expletives.
No, you can use the expletives. Go ahead. It's more fun that way.
Julian, it can't be that fucking bad, can it? And I said the guy's name. Josh really knows his stuff, and I think he's right. And to which the comment was, oh, fuck, click.
And so do you think that this is in that sort of league?
I think, look, when I connect the dots, yes.
Okay.
Now, I mean, I'm not saying that we're going to get a global financial crisis.
No.
But I think in terms of a tangential shift, a mindset shift, an investment portfolio inflection point, yes.
Okay. Now, the next thing I wanted to chat with you about in terms of tariffs is something called I like to dub, and I don't know if anyone else has said this, the paradox of tariffs. You have talked about the fact that the Trump administration is planning to use it as a source of revenue. But if we think about tariffs, if they are successful in driving manufacturing to the U.S., it means that as a source of revenue disappears.
Yes, true.
So it either ends up being a tax on.
We have a stronger economy as a result, more firms over here. Then we don't tax companies in the US, but theoretically, in that sort of dynamic scoring thing that the CBO does to sort of justify the pipe dreams of politicians, theoretically on paper, all those new companies will be paying more tax in the US. Well, the workers they employ will certainly be paying the tax in the US, so we'll be better off.
So do you believe that?
I think in a very simplistic world, I think that makes sense.
Okay.
Right. Tariffs generally, though, I mean, I think people forget, one of the ways that the US started to become a dominant economic power was impose tariffs on the UK, which at the time was the dominant power.
Right.
So you can sort of impose them, and we've seen essentially, that's what the rest of the world's done. They put up tariff barriers, or they put up literal tariffs, or non-tariff barriers, and literal tariffs, and they've stolen industrial production from the US.
Right.
When I add in the financial connections and the dependence of the US economy on those very financial connections to create its own strength, I worry that there's actually a much, as I said, to go back to what George Soros said, this is far from equilibrium. This is inherently fragile. So I worry that I don't think I need to think about, the good side, right?
Right.
You're
just worried about the next move, and the
I'm
next
worried
move
about
is
the
lower.
next move, right?
Right.
If I see that it's starting to happen, then great. I'll be very, very happy. I live here in the United States too.
Yeah.
I'll be very, very happy that we managed to pull this off.
Okay. One of the things that a lot of people will also argue is that there's a Trump put. You've been very vocal that there is no Trump put. I'd love your thoughts about that.
Well, look, I think it goes back to this sort of concept that this guy is aimed at Wall Street and the C-suite, and it's clearly not. I mean, they've literally told you. I mean, what do you need the guy to do? Put on a couple of signs over either side of him and walk up and down, Madison Avenue, right?
One of the other things you mentioned in another podcast is that I forgot that in 2000 the Fed hiked 50 basis points with the NASDAQ down 40%. I had completely forgotten that.
Yeah, I mean, let's be honest. I mean, the NASDAQ was the sort of the sort of pimple on the arse of the global equity market back then. It was worth nothing. I mean, the names were the same, but they were nothing compared to the behemoths that we have today. So really, in that sense, it wasn't really significant. But look, the Fed is going to be in an extraordinarily difficult place. I mean, this stuff is definitively stagflationary, right? I mean, if you look at the, I think it's quite intriguing. We all know in the last, because we're very wonky, right? Because we live in this sort of world that's hyper-focused, that one of the big problems that we've had in inflation has been secondhand car prices, right?
Okay.
Well, look what happened yesterday to Hertz stock, right? Now, it's penny stock, it's kind of crap, but it jumped massively. Why? Because the value of their fleet in the face of a 25% car tariff just rose, right? They have a secondhand car fleet, right? If you're lucky enough to have a large collection of beautiful French wines in the United States, come next week, it might be worth 20% more.
Are you going to show them an offering, Julian?
No. But it, conceptually it's worth 20% more. So, but this is all. This is sorry.
It's all right. Just take your time. Take your time. Back to the Fed. Back to the Fed. They're stuck?
So the Fed is the issue with the Fed is this is stagflationary,
right?
And look, the Fed is definitely erring towards wanting to cut, right?
Okay.
But the issue from an economic perspective is when do they cut? Because inflation and employment are always the two balancing levers of the car, right? One accelerator, one the brake, or if you're trying to fly a helicopter, keep that pitch and yaw kind of stable. It's very difficult to defeat inflation without crushing employment. Historically, just tells you it's very, very hard. What makes it additionally complicated is employment is a momentum indicator. So if you can run a moving average over it, which pretty much always signals a recession, right? And The reason for that is basically one job begets another job, begets another job, and vice versa. One job lost begets another job lost,
Right.
begets another job lost. So the problem that the Fed is going to have is, and maybe we can avoid this, but I'm skeptical if we get a large correction in the equity market, is if they have to wait to see the whites of the eyes of the weakening labor market,
Okay.
it will almost certainly be too late.
Right.
And so that Trump put that essentially the Fed put is lower. And I just want to stress to people that in the last 90 years, the average correction in the US equity market in a recession is 30%.
Okay.
It's not 10. We've had a 12 or a 13 once, right? Once, right? But most recently, we've had a lot bigger corrections.
Yeah.
Right. And given how pumped up this one is at the moment.
Yeah. 22 times earnings. Like, it doesn't even take much.
Quite fearful.
Yeah. Like I always tell people, go put a shallow earnings recession on those, whatever amount of earnings we did, and then put us down to 15 times earnings and figure out what the returns are. It's ugly.
Yeah.
It's ugly. One of the things I heard you mention recently is you talked about the sovereign wealth fund, which I think you correctly identified that it's kind of ridiculous. The U.S. is a net debtor on the whole. But you brought up this idea that maybe if they go and intervene in others, foreign exchange markets, they could use that money to invest, and that will be kind of the source of it. As I was listening to you say this story, I realized that on a global basis, that's very inflationary. Am I wrong?
I mean, a weak dollar is if you come in and this is one element of the Mar-a-Lago Accord that Stephen Mirren lays out. This concept that what we're trying to address here is we're trying to he doesn't lay out the sovereign wealth fund per se. What he talks about is these mercantilist countries, be it South Korea or Japan or China, that have kept their currencies artificially weak relative to the dollar so that their exporters gain advantage. And he said, well, if we decide that that's the case, or we make that decision, we would go in there and we get the Fed to print this money, and we'd go and sell those dollars and buy yen and renminbi and South Korean won. So printing the money, arguably inflationary. Maybe the Fed can sterilize it. Sterilized intervention generally doesn't work.
Right.
Secondly, weak dollar, historically pretty inflationary.
Right.
Pretty inflationary. I mean, you can do the rate of change on the dollar, and it's a decent proxy for CPI. Now, a lot of that has to do with oil and what happens with that. So we will see. I think that's in a massive, great big wedge. So if we can break through kind of 66 on WTI, maybe we're fine. But if we start to move much above 78 to 80, that would be worrying, because remember, it's denominated in dollars. So conceptually, as we reduce the value of the denominator, that should go up in value, but we'll see.
Okay, we're getting towards the end. Julian, what question do you think that I missed asking you? Like, if you're thinking about something that's important that you're talking to your clients about or folks, what did I miss asking you?
I think honestly, I do think you've covered, you've clearly done your homework, and thank you very much for that. I think you've really covered most things. I do want to stress to people that we all suffer from recency bias. We all are products of the information that we get that assails us on a daily basis. We need to understand the motivation of the people who are espousing those views. So the cheerleaders on CNBC and CNBC themselves. I mean, their ratings go up when the equity market is up. They go down when the equity market is down. They generally, in that reason, don't want everyone walking out there and peeing on the bonfire, right? So I think you need to understand the motivation of that. We need, the recency bias makes us go, oh, well, I bought every dip. It's always worked. I bought every dip. I think there are times, and this is hard if you don't have that life experience, when you need to take a step back and you need to think bigger picture. And you have the thoughts and you say, well, I think this could be changing, and I think maybe this is a big event. And then you need to focus on price action, because we are very frequently early. But one of the disciplines that we have is that we look at the story. We then look at positioning in the market and we go, if we are right, is it already in the price? Oh, no, it's not in the price, right? We think we could be at a tangential point in US equities and US assets and the dollar. How is everyone positioned? Well, after, a decade plus, probably pretty long US assets, pretty long the dollar. Okay, we got that. And then for the confirmation, you need to be looking at the short-term price action. And I think the short-term price action is getting very intriguing.
Got it. All right. Before we sign off and we let you tell us about your firm, I'm going to spring a kind of personal question that I'd like to end something on. And I was just telling you, I was driving with my kids the other day. I have grown kids, and we were chatting about if you could go to any concert, throw time, go back to any concert, and see this band, what would you choose? And so I have my middle daughter is like a little hipster, and she's like the 1978 Fleetwood Mac in Sacramento or wherever it was. I don't know. There's some concert. Another one was like, I'm going to go back to Alanis Morissette. I want that kind of concert when she was really angry. I would love to know if you could go back in time and see any concert, what would it be? And give us the band, the time, and why.
So I think it's tempting to say, I'd like to go back and see the Beatles. I think part of the problems with the Beatles would be, all the girls that were screaming, you couldn't hear it.
You couldn't hear it. It was a terrible concert.
So for me, look, it's always tempting to say, I'd like to go and see, Beethoven play in Vienna, in front of the Austrian royal family. I think, no, for me, the formative one was Live Aid. I'd like to go back to Wembley Stadium, Live Aid. For your younger listeners, you've probably seen the Queen movie. I remember exactly watching that thing on a 14-inch Sony Trinitron TV, which was cutting edge technology back then. And
that's a great choice.
That would have been a fantastic concert.
But that's interesting because the U2, when they did it, they were supposed to play 3 songs, and then Bono just went on this tangent, went out into the crowds, and they thought it was going to be a disaster. Literally, there were others bandmates were mad at him for it, and then it ended up being the kind of just quintessential U2.
Oh, I know.
moment.
And then Freddie Mercury and the whole thing, and then you had Genesis and Phil Collins, and I remember him getting on Concorde and he flew to Philly so that he could be part of the Philly one, right? Because you remember we had London and the US.
Oh, that's awesome.
So it was all very cool.
That is a great choice. Julian, you really came up big there. All right. Why don't you tell people about your firm, where they can learn more? And you recently have a new retail product that you're launching. Yeah. So why don't you start with that and then also follow up with where institutional guys can get a hold of you? So
look, the institutional product's been running since 2011. As I said, it was very kindly funded by one of my continued clients still as today. Hopefully we're making them as much money as we did that justified that initial check. So if you are interested in an institutional product, you can hit us up at support@mi2partners.com, or you can ping me directly. I'm on Bloomberg, and you can get hold of me that way. And we have a retail product, which it's different. I mean, there are certain things that institutional guys will do, and retail guys, it's far harder to do. And there are certain things that retail guys can do and institutional clients can't do. Institutional clients, can't lose certainly if they're a hedge fund 5% or their position go against them 5%, right? The retail guy can take time and take the bigger picture and has that kind of luxury. And that's very much what we've aimed to do with the retail product. We want to try and educate people in macro. We want so that they can make their own decisions and formulate their own thoughts. And it's not the most intuitive space. It's actually quite hard space to do. And we do want to make people money. I mean, we don't pontificate. We put trade ideas. We put ideas. We said at the beginning of the year that you should be out. You should have a lot of cash in your portfolios. We think the S&P was going to 5,000, and I think it's probably going to at least there as events have unfolded. And so, the objective is to try and preserve your wealth and hopefully make you money along the way, and be considered in our thought process and not just be one of these kind of it's all great, kind of people. I don't know whether it is all great right here, right now.
Right. So how can people that are interested in that product?
So that's called Macro Capture.
Yeah.
And you can also, you can go onto our website. I think you can sign up there, or you can just tell how much of the mechanics I get involved in. I'm trying to focus on trying to get the market right, which is pretty hard, along with my other 5 colleagues who do the same.
Right.
I
did see there was a contact spot on your webpage.
Yeah. And then alternatively, ping once again, support@mi2partners.com.
Great. Julian, it's a real pleasure getting to know you. Thank you very much for taking time.
My pleasure. Thank you.
Take care. All right, Patrick, time for talking charts. What do you have for us?
Well, listen, let's dive in first. Let's talk about the top 3 things that we need to watch until next week's episode. Number 1, we want to look at that JP Morgan options whale. And you've been writing about this quite a bit. And you've been talking about it. I've been talking about it. But what was interesting was I didn't think the market was going to go gravitate to it. But the strike, let's just actually put up a chart and highlight this. So here's the SPX. We're at 56.05 after today being down almost 90 points. And the strike price for the March 31st expiration is sits at 55.65 right over here, right? And so we're 40 points away. And already the delta is building on these options, which is obviously part of today's selling is dealer having to go short again. But maybe you can explain it better, but we've got a situation where the dealers have to hedge this 20 billion notional position. And if it goes through the strike, it could get ugly, right?
Yeah. So this thing expires on Monday, on March 31st. And the dealers that are on the other side of this find themselves, as we go lower, you correctly identified that they end up being short gamma. They need to chase the market down, and then they need to buy it back if it goes up. Because if let's just take, at extreme of on the day of expiry, if it's right at the strike, then they're going to be short, $10 billion notional. And if it closes lower, they have to quickly sell $10 billion. And if it closes higher, they need to buy back $10 billion. Now, it's not quite that simple because he is going to roll it over that period. So it will come off on March 31st. But the real problem is this weekend.
Yeah.
They're stuck wondering, what if we got a situation where we gapped down again? So we'll just imagine you're on the other side of this trade. The machine's telling you, your option calculator's telling you that you have a 50 delta. Do you overhedge? Do you sell a little extra because you're worried that potentially we get some bad news and it keeps going? Or do you hope that it's going to be far enough away so you actually underhedge? And the size of the position, Patrick, is so large, we have this tail wagging the dog effect.
Yeah.
Where the volatility around this strike is much higher because everyone is short.
Yeah, and it's funny because it just goes to show, like, okay, there's the sentiment of investors, there's how portfolio managers and everybody are positioned, and those are going to influence trends over weeks or the next month. But we're at a very unique situation where flows driven by dealer positioning and the systematic trading is actually coming all to one point where it is so big that at least over the next couple trading sessions, it's the big thing. It's like
Yeah.
it overwhelms everything else.
It really does. And you really, unfortunately, because of the size of these option markets, they're increasingly something that everyone should pay attention to, even fundamental investors, because it's moving the markets.
Absolutely. Great time to be hedged,
Yeah,
right?
that's right.
And those that don't know how to hedge, there's a special webinar on that at Big Picture Trading now. Shameless plug. Anyway,
I love it. The segue was really well done. Okay, number 2, what do you got?
well, number 2 is the jobs numbers. So
Yes.
next week we have the jobs numbers, and it would normally be number 1 if it wasn't for
Liberation Day.
Yeah, Liberation Day. But jobs numbers is everybody is tiptoeing around whether or not there is going to be a recession or not. And obviously, I would argue that jobs numbers in some way are not leading indicators. They often only start rising once you're already in a recession. And so if those job numbers come in a disappointing way, suddenly the stock market could find itself in a challenging situation. Now, I mean, there's a whole bunch of people on the street that all have different opinions as to whether or not the recession risk, what's the percentage, what are the odds. But I like poly markets because people are putting real money on it. No, because that's real money, right?
Yeah,
Like
fair enough.
if you think it's mispriced, you're going to go and lay into a bet on there. That's giving a 1 in 3 chance of a recession this year. It's at 35%. And I think that if that jobs numbers comes as a miss, that's going to rocket.
Yeah, won't disagree.
Right. And so that's it's going to be, and if there's any risk of a recession, the stock market ain't going to like it.
Yeah. No, I'm with you, Patrick. Something's wrong with the world right now because you're making sense again. All right. Number 1.
Number 1, the tariff announcements.
Liberation Day.
Liberation Day. And
April 2nd, for those who don't know.
Yeah, because we wouldn't want to do it on April Fools.
I actually wonder if it was going to be April 1, and then he's like, whoa, we can't do it because no one's going to think it's serious.
No, actually, yeah. You know what? There was a statement out there basically saying they didn't want there to be a risk that people think it's a joke, like that that's a April Fool's joke, that this tariff's coming out. So literally, to remove the confusion, they waited till April 2nd. That's
I did
bizarre.
not realize that. That is hilarious. That's awesome.
All right, but and nonetheless, this has become the obsession of the markets.
Well,
and
you say that, Patrick, but do you really think that that's correct? Because I might argue that it's actually people are surprisingly casual about it. And I'm going to just read this quote that Chris Sidial, I don't know how to pronounce the last name. I apologize, Chris. He says, I've seen my fair share of bizarre things in equity vol over the years, but the market's continued pricing of April 2nd as the end of the tariff wars rather than the beginning remains one of the more puzzling ones.
Right. Because the vol structure actually after April 2nd goes down.
Yeah. And even even April 2nd, the amount of extra vol there is very limited.
And what kills me is that that's before the jobs number. Like, why wouldn't the vol at least stay elevated into the jobs number? Like they could put the core PCE price index today as the higher vol point than even April 2nd.
So I just go back to your comment that everyone's focused on it. It feels to me that everyone's assuming it's the art of the deal. It's not going to be that big a deal. And we just had this, discussion with Julian, and Julian obviously feels the other way. I'm sympathetic to that view. That's where I come down as well. And I think that vol kind of out next week is cheap. And
yes,
Patrick, the world's really something strange. Dev's along vol with Patrick.
And more importantly, it's not just that for next week. Vol, we're recording this right now at lunchtime on Friday. vol is cheap for the rest of the day. Like with the JP Morgan whale there, as we're speaking, look at this chart, Lou. We're now down to 55.91.
That's
We're
spicy.
like this is crawling to that strike magnet, and this, like, Kev, all right, it's a liquidity event. We're not going to use the C word, but a little liquidity event driven on the downside is never the highest probable outcome. But if you were to offer off the top of your head the probability that we bust through this red line today, which is right along that strike, what odds do you want to give it?
Oh, I don't know, Patrick. All I know is
come on,
this
entertain the people that are listening. What do you want to give it?
Yeah, it's just like a no-win. I'm going to lose regardless. This is what I will say. The chances of us closing, like right now as we speak, what is the S&P futures? 56.37?
But it's 55.90 on cash, which
okay,
is where
56.37. We're not, sometimes you go down and it just goes sideways and nothing happens as we approach it.
Yeah, which is a higher odds.
That's a traditional play. I think that we're either going down another 50 or up another 50 from here. We're not closing here. Now watch this. Everyone should sell straddles for like right here, because that means we're going to be pinned.
They're not going to hear. They're not going to hear it till the weekend.
I know, but they'll be like, damn, that was some huge alpha Kev offered there in terms of fading him. I just think there's a lot of negative gamma out there, and I don't know. It's very difficult to judge how much of this decline so far was just the folks on the other side of the JP Morgan whale trade with all that negative gamma pre-positioning, and will they have to chase it back the other way? There's just, it's so crazy in terms of this position size. Like I like to tell the story, Patrick, when I first did the math on the JP Morgan whale trade, I was trying to figure out something in terms of P&L, and it was off by like 800 grand or something. And I was like, kept doing all this work, and I'm like, what's going on? And then I realized I had a rounding error. Like I was rounding, and the position was so large that was what was happening. It's just, it's really difficult until you stop and do the math and figure out how many contracts and how much this means in terms of how, the effect on the actual marketplace. You just can't appreciate it. So one of the things that I'm sure of is that nobody really knows what's going on out there right now, and that it's scary.
So I will say this. I would say that because I'm going to play this game that I made for myself, that you didn't want it to risk it. My call is this. It's never the high probability bet that the market's going to dump. So like, I don't want to go and say that this is a better than a 50% chance. It's less than 50%. Like right now we're approaching that strike. But what I do believe is that if we do clear that strike, it isn't going to be 50 points more. It's going to be 100, 150 points more. It's going to be a 250 point down day at its low swing if that gives out. I think it's going to be that kind of a Friday, where it's going to be one of those days where we're going to be talking. So I don't give it the high probability, but if it did happen, I don't think it's just going to be 50 points below.
I hear you. I think that's the right call. You're correct.
All right. Well, you did say 50. All right.
No, anyway. I yes, you're right. On the downside, I meant 50 on the up, but I said 50 either side, and that you're absolutely correct. I'm scared to make the big call that it's going to go down 150 like you are.
But it's not. But listen, our listeners can hear. We're not saying that it's the more probable outcome.
I understand.
It's not. But the thing is that it's that much volume of trading that's coming in, because it's also about fear. The amount of people that have got anxiety here, and the amount of people that covered their hedges on the last bounce. Remember, who was it that you were telling me always says it's the second leg that is?
Oh, that's good old Dean Carnut. He says it's the second move lower that always crushes people, because the first
is the second move. The guys that hedged the top covered their hedges on that bounce. And the thing is that there are less people hedged right now. And the fact that that bounce was so pathetic, and we'll talk about how pathetic the bounce is in a second. But I think that there's enough nervousness that will join the dealers on the sell. All
So
right.
Pat, here, I just want to clarify. You are absolutely correct that usually when something is down 150 points, 165 points on the SPOOs, you would say the chances of it accelerating from here are very low. But given the JP Morgan whale and the setup going into this weekend, there is a higher chance than normal that it accelerates. So I will completely agree with you there.
Right. Okay. So let's, I want to talk
Patrick,
about,
if it does collapse, you'll be the guy. You'll be the hero. It's like, listen, Kev was mopey and Patrick was the guy who put it all out there.
no, you came in and joined the party. Nobody's going to pick on you after this. So
Oh, anyways, okay, let's go on. What do we got?
okay. Well, I wanted to talk about a couple of the key components because, okay, so the S&P is down 1.8%, but what is down bigger is the NASDAQ, 2.5%. The NASDAQ is just a stone throw away from its actual previous lows. So the key highlight I want to make here is, and more importantly, guess what? What percentage is the Mag 7 down? The Mags ETF, 3.16%. The Mag 7s are back to their March lows.
Got it.
Right. And to me, this is very, very important because if the market bounce was a buying opportunity, then reflexively, those things that sold the hardest should have had the most reflexive snapback the other way as a buying opportunity. And the bounce that we had other sectors like energy stocks and other things that were rallying, and the Mag 7s didn't. And that to me is something you can't ignore. These Mag 7s are still being sold. And that to me means the sell-off's not done. And while we've been obsessing about the JP Morgan whale and what it means for the next day in the price action or the weekend, the fact that the Mag 7s couldn't rally, this bear leg is not over.
Okay. I've
it's
hated
not-
the Mag 7s for a while. I think that the big picture, they're headed a lot lower.
So now there is a famous technical analysis saying that basically says flags fly at half mast. Have you ever heard that one?
No.
Okay.
Tell us that.
So a flag is when a market bounces and creates like a flag on a pole. So imagine this being the flag and this being the pole.
Okay.
Right. And the saying is that flag flies at half mast, which is the length of the next drop is going to be similar in length and magnitude as the prior decline. And that means that from this point, if it was of similar size, you're talking about another $11 drop, another 23%, all the way back to the August lows where the mags would be trading around 38 to $40 on this index. So that's if the flag flies a half mast here, then there's another full leg coming on this, and that doesn't have to happen with the JP Morgan drop. This is likely a risk for the weeks to come. Maybe the tariff thing is the trigger. Who knows?
All right. I love it. I learned some technical analysis wisdom today.
There you go. The other thing I wanted to highlight, if one was to drink the Trump administration Kool-Aid, that basically they're transitioning from less fiscal, but by deregulating banks, re-stimulating economy, cutting taxes, they're trying to make a very tactical transition in the economy and want to do without triggering a recession. Is there some way that you want to explain it differently now, or do you think that
you're absolutely correct? They're trying to
So-
move the reliance on federal or government spending to private sector. You're absolutely correct.
So, in my opinion, the one space that would be the biggest benefactor when that transition is underway is small caps. And the fact that small caps, that this bounce was so pathetic relative to only the Mag 7s had a worse bounce than the small caps.
Okay.
And the point being is that if the market was in any way anticipating that this is successfully happening, then the small caps should be taking way better flows, and they're not. They're selling hard. They're selling. They were not overvalued the way a lot of other parts of the market were, and yet they're one of the weakest spaces and continue to be weak, which to me continues to highlight the vulnerability of the current market.
I couldn't agree more, Patrick. And I think that the problem with the small cap is that it's one thing to say that the deregulation is going to cause private sector to spend and, have that theory. But then when you go on again, off again tariffs, when you go and accuse and you threaten the sovereignty of nations, those are not behaviors that encourages business to take out their wallet and start spending and going and borrowing because they're confident in the future. So I think that whole concept,
business confidence.
Yeah, I think that whole concept about private sector credit creation can be thrown out the window because of the uncertainty of the policies of the past month or two.
I agree with you completely. And so to me, we have a very vulnerable market that is highly susceptible to more selling. And whether it's the JP Morgan whale that causes a big downdraft today, or whether this is something that happens in the middle or of next week, we'll see. The one thing that we did last week and in weeks or in prior episodes, we measured the length of the average decline and the bear market rallies that happen in the subsequent weeks. And while the average bear market rally was, let's say, 7 to 9%, 10% often, and in some extreme cases, even 20% if the magnitude of the prior drop was severe enough. The one thing to highlight is that the average length of a bear market rally tends to be only 2 weeks.
Right. And we had that.
And we are pretty much at the 14-day mark. Like, look at this. Like, this is already the 15th day. Yeah. Like, we've already had a 2-week market bounce. And so a lot of these things you have to be cautious in this market. You have to be cautious. This is not the time to be brave.
Okay. You heard it here.
Now let's talk
cowards.
about another. We're
going to be cowards.
Absolutely. You know what? Cash is king. Cowards, baby. Cowards.
All right.
So unless you want to lean in short. Now the next thing with the market, with the mags all the way back to their previous lows, with the S&P breaking down the way it is to that level, the VIX is only at 21, Kev.
Yeah, well, that's going back to Chris's point. I think the market is shockingly complacent. I don't think that's actually a good thing for the folks that go, oh yeah, it's because everyone is so confident. I think that means that if there is a problem, that everyone is overly long and unhedged, as you put out, as you implied earlier. I think these are all bad signs. They're not good signs.
This is a bad sign. Yeah. Like if today was going to be a short-term low and it was going to snap higher, you would think that it would have come with some sort of a vol spike that everyone's, oh, I'm scared, and then it comes off from a spike, but we're not seeing that.
Yeah, there's none of it.
And
actually, are you going to talk about? We're going to talk about the little precious little yellow fellow, because I got something to say about that too. Because I think you're seeing the same sort equities. Because same sort of complacency there.
Yeah. So let's talk equities first, and then we'll do commodities next. First of all, 1-day vol we're not from this is the 1-day volatility for those 0 DTEs. We're still at 21. I mean, last 2 weeks ago we were at 30. Like, again, we got this 100-point drop in the markets going to a JP Morgan whale strike.
Yeah.
And 1-day vol is a freaking 20.
Yeah. I know, you're absolutely right.
Then take 6-month vol, not that far off of its 2025 lows. 1-year vol still just 1 or 2 vol points above its year lows. Volatility is not expensive yet. It's cheap.
Couldn't agree more, Patrick. It's across all curves, across all assets too.
Yeah.
There's nothing. Nobody's paying up for any vol.
No.
Nobody is scared.
It's crazy. Now let's talk global equity for a moment, and then we'll go to commodities like gold and stuff. I want to highlight that the Nikkei is behaving like shit.
Yeah.
And
I'm not
sorry,
going to disagree. I'm not going to disagree there. One of the things I think is wrong with the problem with the Nikkei, Patrick, is
Yeah.
if we think back to last year, what was the only non-American index that did well?
the Nikkei.
Right. It was the only one. So I think what we're seeing here is unwinding from people that were long American stocks, long Japanese stocks, underweight Japan, Europe, underweight China, and that's why Japan is struggling. That's my feeling.
So I would make it much simpler.
Okay.
I think that right now risk assets are generally being sold, and the Nikkei is like, if you look at the percentage of the drops and the days that it's dropping, the days that it's rising, we're just getting direct correlation to U.S. equity markets. Like,
But that's making my point. That's because
but-
people are long the US and the Nikkei.
Yeah. So the point is, it was a 9% drop over exactly the same 2 weeks. It was a 6.5% rise. Like, literally, the Nikkei is just step by step, day by day, literally mirroring the performance of the US. And the only point I'm going to make is, right now it's a risk asset, and it's likely to continue to correlate with US equity markets. And you have to treat it that way. You're not getting any safe haven by being in the Nikkei at this point.
I won't disagree, except for that it might save you on the dollar.
Okay.
That's
If the dollar has a dump, yes.
Yeah. Well,
What if we have a true liquidity event and the dollar actually rips?
What if it's the other way around though? What if we have a liquidity event and the dollar
I'm
goes
just saying.
down?
I'm just saying.
Can you imagine
it's,
that,
It's not a
Patrick?
given. That would be ugly. That would be. It would be ugly as fuck. Like,
And
that would.
yeah, and Julian had a great point that I thought was so interesting. Like, if I picked one thing out of Julian's interview that was just like eye-opening to me, was his recounting, talking to European pension plans and how they would say, I can own extra mag 7 because when we have a risk off event, the US dollar goes up. Meaning it's kind of like how, Ray Dalio did his risk parity and could buy stocks and then mirror, accompany that with a position in bonds. And because bonds were negatively correlated, he could own more of both. Yeah. Because in a bad environment, when stocks went down, the bonds saved them. So a lot of European pension plans and other kind of European long-term money would look at it and go, I can own extra Mag 7, because the reality is that when things go really bad, the US dollar goes up. So I think that a really scary thing, Patrick, would be if they both went down.
Listen, I get it. I get it. Because that is the natural thing to expect, the US dollar to rise during a decline. Yeah. So touching on Euro stock, the Euro stock has been outperforming on a relative basis. But I was asking the question as to whether it can continue to move contrarian to the or inversely to the equity markets in the US and rise. But the way it rose and fell right back down, I still believe the statement that a long short pairing of short US against a long euro will outperform. So if you're a hedge fund and you're in a long short positioning, then that pair trade is golden. I'm not going to push back. But the way this price action looks, you ain't got no safe haven in being in the European stock market if the US equity markets start dumping.
Yeah, I just laughed the way you worded that. You ain't got no safe haven.
They got no safe haven.
People in Narrow and Sound and upper Canada would be very proud of you there.
Oh, thank you.
Letterkenny guys.
Yeah, absolutely. So anyway, the point being, though, that I do think that we're approaching a stage where if this market accelerated to the downside, that risk. It's going to be true risk on, risk
You're
off
saying
market.
it too much. It's not going to happen now because you keep talking
No,
about
all
it.
I'm just saying
No, I know, I understand, but we got to stop
is
talking
that
about it.
okay. So let's move on.
Let's move on.
So
Let's talk gold, because you highlighted how the stock market is amazingly complacent with the volatility. And I came up with the same thing yesterday about gold. I sent it out, and I have this kind of nightly recap where I post some charts that I like and highlight things. And I was shocked because, first of all, gold, one of the best performing assets out there, all-time highs. No one cares. No one cares, right? Like nobody cares. Nobody talks about it.
More importantly, I've seen at least 2 reports out there, from the Goldmans of the world that are basically saying it's a little bit late in the move. You should only play with options on the upside.
Yeah.
That being long gold here, like basically they're saying it's not asymmetric anymore. To be pressing. So they're already talking back the rally before anyone got excited about it.
So nobody cares. It's the most thing. But then I pulled up 1 year vol, and I expected at the very least the gold market to have incorporated some sort of enthusiasm in there, but there's none. And then more importantly, Patrick, I did the skew, like I did 25 delta versus 25 put. And for those who don't know, generally on gold and precious metals, the right-hand skew trades higher. I mean, the right-hand implied trades higher because
it's a true smile.
Yeah. Well, and not only that, it's the smirk
Sometimes
is on the other side, right?
Yeah.
So in times when people are really bullish on gold and very excited and worried about situations, they pay up for the call because they're worried about that gap. And there's nothing. Like I was flabbergasted at the lack of vol bidding up and at the lack of change in skew. There's none. No one cares. It is shocking to me. It's like all I can say is that as a bull, this is the greatest thing you could ever ask for.
Fair
like
enough.
The last thing you want is everyone owning it and everyone excited about it and talking about it. But right now, there's none of that.
No, and I'll agree. Here, I just have the gold volatility index. It's not the 1 year vol, but it goes to show that we really haven't. I mean, whatever print was on an intraday basis here that faded, but overall volatility is right at the bottom end of its ranges. There's nobody that's rushing out to buy upside vol.
I find it one of the most confounding things out there.
I want to highlight. I want to highlight when you're looking at continuous charts, because some people do this gap up. It shows $56. It's the contract roll. It rolled from the Aprils to the Junes, and so here I'm just looking at the April contract. It did still break to a 52-week high, but it's not up 50. It's up only like 28. But it is a break to a fresh high. I've been talking 3,200, and I still think 3,200 is the path of least resistance. And this thing just continue to rip. And what's also interesting is silver broke to an all-time new high. Now it gave a little bit back this morning, but it's still holding at like 52-week highs. And so right now, if silver joins the party, that kind of in some degree or another is a confirmation to me, because it means that the participation is broadening. Even when you look at the GDX, the gold miners broke to a fresh new 52-week high.
Okay, Patrick, I got to interrupt because you said all-time new high. It's
no.
It's for those who don't know, it's all-time high for this move.
Thank you. You're right, because in 2011 there was this $50 high.
Well, in 1979 and 80, they had a kind of a crazy day too.
Yeah, that was this one right here, right?
Yeah,
so
I'm looking at cash, and it traded at almost $50 in 79, 80, and then in 11 it traded at $50, and so we're still ways away
from all-time highs. Yes,
yeah.
But we broke a 52-week high, the high that was essentially established over this last.
Okay, here I got a question for you, Patrick. Yeah. Is it finally time to buy the miners? Give us your technical opinion on that.
The miners, okay,
yeah, like
it depends which one.
Okay, so start with GDX. Give us your GDX.
Like, is it finally time? What do you mean? The thing is literally up in the last
No,
3
but
months.
I get it. It's up, but
Is up
is
like
this for real? Because a
40%.
lot of people are still thinking it's not for real.
It's for real, but there's not, but the asymmetry is already diminishing. Like, just as an example, this run that happened in 2024 was an $18 rise, right? And it took about 240 days for that $18 rise. Now, again, using that kind of rule of the flag flies at half mast kind of thing, you would expect that a rally it would be about 18 bucks. We're already $13.50
No, but
into
you got to do it in percentage terms. That's not fair.
okay. No, it's I actually disagree.
Oh.
Price level actually works in technical analysis. Point being is that you can't be already in the fifth, sixth inning of a potential bullish impulse and then say, is it now the time? Like, there's more upside. Can the GDX be trading at 50, 55? Absolutely. Can this trend continue? Absolutely. This is still bullish. But do I buy 46 bucks thinking that I've got asymmetry in the trade? I'd rather buy dips. You have to maybe use optionality to build the asymmetry, right? Like, do some bull call spreads or something. But I love it.
Best bull
It's
markets
bullish.
never let you in, though. The best bull markets don't let you in.
Listen, I'm bullish. I'm
I know.
long. I'm not short. I'm not selling. I'm just being careful to not make it sound like, is it finally? Yes, this is the moment. Now's
Okay, fair enough.
you know what I mean? Like, yeah, I'm
Yeah, fair
just
enough.
be careful about the language. It's like I've been long this shit for the last 2 years, so it's like I'm enjoying the ride, but it's my upside target is in the $50-$55 range for this impulse.
Okay.
And so I still think there's another, solid 10 to 20% upside on miners from here, but you do need to manage that risks when you start buying at these kind of levels. All
Okay.
right. The what is interesting though is there are obviously miners that are dogs. Like, I'm going to pick on Newmont. But like, Newmont hasn't been able to beat its 2024 high. It's just starting to kind of come to life. You look at Barrick Gold, that is starting to crawl back toward its highs. But the Agnico Eagles of the world are running like they stole something. They're like it's like the full-on bull phase. But there's a lot of these big mega cap gold miners that just haven't joined the party yet. But if gold is going to be at a sustainably higher level, and while energy prices are cheap and all this stuff, these miners are going to be printing money.
Yeah.
And this is not priced in.
Well, that's my opinion is that the real move has just started. Like, this is, I hear what you that it's up a long way, but in the grand scheme of things, like, step back, they're still cheap. The gold is still up there. It doesn't take much for these to really get
By
stupid.
the way, so I want to highlight, when I do my technical analysis and have a $50, let's say, target on the GDX, that would simply be where we would expect a consolidation, just like gold would consolidate for 2 months sideways. But if you're talking about a 1-year target on
No, I hear you. I understand.
right?
That.
Like,
Yeah.
if you're then the targets could be much, much higher. So I'm just talking about the most immediate technical upside from a.
You're talking about the squiggles. Got it.
Yeah.
Okay. What else you want to talk about?
I wanted to talk some of these currencies. The dollar remains still like, look, I was for months trying to build the case that this was a bull continuation pattern, and that this thing was going to, from these higher levels, continue bullishly higher. And the currency whisperer got me. He got me. Anyway, but the point being that this breakdown changed everything. From a technical perspective, it destroyed all of the technical patterns of a continuation pattern and shot the dollar back down into its 2-year trade range, right? So if I put this on a weekly chart, this period back over here, 2023 and 24, was this period where the dollar just bounced around in a 5-point range and was stuck in there. The whole bull thesis was we broke out of that range and we were heading higher. That's dead. right? That thesis is dead. So the thing is that now the question was, well, where is it heading on the short term? Well, the reality of the circumstance is that if this rally here, I'm going to put on the daily charts again, if this rally is as weak as it is, then the most immediate downside risk, like that same saying of the flag flies at half mast, you're talking about a scenario where this goes back down to 100 on the short term. Obviously, you have your long-term view that this is a major multi-year bear market, but I'm just talking technically the next move.
Okay.
And technically the next move, if this is the best the bulls can do after this magnitude of a drop, there's a reflexivity in the markets where just like a short squeeze, the rallies are supposed to be fierce and painful for people that are short. And instead, you get this absolutely pathetic 2-week bounce in the dollar that is pathetic. It literally was a shameful rally in the dollar, which
Shameful. Shameful rally.
Shameful rally.
You dollar bulls, you should be ashamed of yourself.
Well, shame for not showing up. Like the point being that this is very okay. Let me put it less emotional words.
No. I like it.
The price action is shit.
Oh, yeah, there we go. There's the technical term again.
The price action is shit. And therefore, the path of least resistance is the prevailing trend to actually continue. And from a symmetrical perspective, that measures back to 100.
Got it.
On the Dixie. So that short term, it's the way it is. Bitcoin down 3.5. My whole argument here on Bitcoin is that by being securitized, it literally has become a risk asset. And as risk assets are selling, Bitcoin is succumbing to the same selling pressures. And this is the same kind of a flagging formation that basically is sending a breakdown move measuring to 70,000 on the downside. But the problem with hitting 70,000, it's kind of a no man's land. The thing is that if it gets down to 70,000, then you're talking about the following months that this thing is coming right back into its 2024 consolidation ranges in the $55,000 to $70,000 range. And so if this breakdown move and this failure at the 50-day happens, Bitcoin still has another 20, 30,000 points to go. It could get ugly. And that's
Patrick, I hear you talking about this stuff. You obviously haven't put in the hours.
More importantly,
do I have to tell you about BTR?
No.
Bitcoin total return, 29% a year. Put in the hours. Like, really, I want you to put in the hours. Go spend some time understanding. There's this guy, Michael Saylor. I don't know if you've heard of him.
No, I've never heard of him.
Yeah, but anyways, he's got this thing, and he if you put in the hours and you truly understand it, you'll get to understand what a BTR is, and then you'll change it. Mind blowing.
It's mind
change your mind.
Unfortunately, from a trading perspective, that's short-term vulnerable, no matter how much hours you put in. Unfortunately, it is the way it is. Highlighting the one thing I know you
cracked there. Highlighting. It's like, what is Kevin doing to me? All right, let's go.
Euro is the leader, the strongest currency across. And
so wait, if I got this right, you started talking US dollar, you went to Bitcoin, almost implying it's a currency, and now you're going to another currency?
I did it. Sorry. I'm just going where I had them bundled in the charts. I'm sorry.
Fair enough.
It didn't mean it. Point is, this is the strongest, but I wanted to highlight and that an article that you wrote or a piece that you wrote to your members. I was obviously under the impression that the targeting of Canadians with the tariffs was going to continue to potentially put Canada in a vulnerable situation, which could have expressed itself as a weaker dollar.
Right.
And yet it's not weak.
No.
Like the thing is that all of this news is coming out, and the dollar just doesn't want to break down anymore, and the US dollar doesn't want to rip anymore.
Against the
And
loonie, but
yeah,
just because you said euro, but you meant Canada.
yeah, I meant Canada.
Yep.
And so point being that while there is not the relative strength compared to the euro, like if you want to play the US dollar decline, technically, if you're playing the relative strength leader, you got to be long euros. But I this price action on the Canadian dollar make you feel that Canadian dollar is not going any lower.
Yeah.
And it's all agree with your
I've been bearish the loonie for a long time, and I recently changed that opinion. For Canadians that are feeling like there's only bad news, hit me up at kevin@themacrotours.com and I'll send you the piece.
Fantastic. Listen, bud, just quickly, we're right now, let's just lightning round through a whole bunch of quick things. Number one, crude oil bounced, but it was so grossly oversold, it needed to bounce. It could even bounce up to 70, 72. But what I'm going to be looking for is bottoming formations, something to show that the short-term lows are in. It did do a retest. Kevin, what is it that you say about double bottoms or
triple bottoms? No such thing.
So
that is a double bottom, though. That doesn't count.
I was about to say, you're going to get a very important tell here, aren't you?
Yeah.
Because either if this thing heads back down to its lows off of a test of the 50-day, it might not hold. It doesn't mean that there's a big downside, but it means that there's nothing bullish about oil on the interim. And
it's going to go down there because I bought some.
Yeah.
Yeah. It's going. We're done. There's no way. More importantly, what does your other podcast partner think?
He's laying a little low on that while doubling up on uranium.
Oh, okay. Got to give me the updates.
The other thing we should talk about is copper. I forgot to prepare that chart that you sent me, but it is important to highlight. I'll do the overlay of these, but in this percentage manner. But the point here that you were making earlier was that while in the past LME, London copper, and U.S. copper correlated, right? Like you can see.
Well, they didn't just correlate. You could actually do the ARB. So you could buy copper in London, put it on a boat, and send it to New York to deliver into the COMEX.
Yeah.
Now the trouble is that there's all this talk about tariffs,
and the tariffs
they've diverged hugely.
So I've been talking for the last couple of months about how bullish this chart has been, but this has been purely COMEX.
Yeah.
So you're talking about prices in the US ripping, but the prices of copper everywhere else are simply not behaving that way.
They're nowhere near as bullish. And that's why a lot of people are looking at the copper stocks and saying, why aren't the equities going up? And the reality is that copper itself is not as high as it seems. That's a short-term phenomenon for people who can deliver copper into New York before the tariffs kick in.
Yeah. Yeah. And so nonetheless, I just thought it was worth mentioning.
Yeah, no,
it did put a short-term high in, but that doesn't mean it's the high of the move. What is going to be the big tell for me, Kev, is that if you expect some sort of like 4, 5, 6 sigma move on the upside, then the tell comes literally now. Usually, when a market reaches the parabolic phase, a 2-day pullback like this is all you get. Literally, it's a very short term, and the buyers buy the dip right away, and it rips. If every day that passes that this thing goes a little bit deeper and farther down, the more likely it is it's not having another leg higher. And so if there's going to be a rip, I would say it's going to happen next week.
I'm just looking at this vol, like trying to figure out, because maybe I should own vol. But what contract are we looking at when this spread is so wide? Like if we go look at the curve
right now, I just compared the May contract to which.
The whole curve is up. Actually, it's all delivery. I guess it's because they're assuming there's going to be a tariff, so therefore copper in New York is going to always trade higher. Okay, because I'm thinking, Patrick, that you should, if you're correct, that we're either going to go parabolic, or it could normalize. This is the time
Straddle
of
it.
my vol. Straddle it,
straddle.
baby. Yeah,
It's
I'm with
true.
you. Look at me. I'm just like long vol everywhere. I'm like a madman.
You're a madman.
Yeah.
I love it. I love
I'm
it
gonna
though.
like
I'm proud. I'm proud.
I know you are. Thanks, Dad.
It's
All right. What else you got?
you know what I mean. Just highlighting your uranium had a little pop and drop on the U.UN, but spot prices uh, never confirmed it. And when you have these kind of rises, like look at this 2-day pop, and then it came right back down. You have this 2-day pop, and it came right back down. It just means that somebody came in there, tried to rip it, and they just sold it into them. This price action, unfortunately, no matter how good the long-term fundamental story of uranium is, this price action is shit.
So for folks that are Macro Voices listeners as well as Market Huddle, tune into the Market Huddle to get Patrick's true view about uranium. It's trading like shit.
It is. But you even then, like, let's say you take the URA, like, look how fast this little shallow, it looks like a Mag 7 stock, like a little tiny shallow flag. Then it's sold right down to its previous low. And you know what, Kev? There's no such thing as
Triple bottoms. Whoa. Now there's something. No such thing, man.
right.
Yeah.
Like this is you have to. It might not be over. It might not be over in this.
Don't tell these other podcast hosts saying bad things on our show.
But what I am bullish on is the TLT.
What else is new? So, but you know what? The thing I like about our show, is that you're allowed to have those dumb opinions on our show.
Dumb opinion. I hope the market gods teach you something here. Listen, I got schooled by the currency whisperer. Maybe a market god is gonna teach you a lesson here. The point here is I did a 50% retracement right down to the moving averages. Look, while I believe there's a chance that the US dollar could weaken during the risk off cycle, I do not believe that will be the case for bonds. I believe that whole thing we saw in 2022, where bonds were selling with stocks, was because 2022 was actually a bond bear market, not a stock bear market.
I agree with you there. The bonds led that move down. I 100% agree with you there.
And my view here is this time it's an equity move. And at minimum, while there may not be a huge upside on these, there's definitely going to be a carry that you get in being in these bonds. And I don't think that the downside is remotely anywhere near as risky as the equities at this juncture.
Oh, well, no doubt. I'm not going to argue there.
But I honestly think we could see 100 on the TLT.
What is it right now?
At 90. I think we could have a 10%.
So you think we could have a 10% move? Listen, you might not be wrong there, but the reality is if that happens, it's probably better to own Harley's TUA.
Well, even better, you just go long the SOFRs, and that's what I've been doing. I've been buying the December 2025 and the December 2026s, looking for the 1 and 2 year kind of durations to actually price in lower interest rates.
Look at you. You're trading this. You're going to be a stir trader.
We're going
to get you trading butterflies in like mid-curve butterflies before long.
Before long. But I have not ventured into trading the shorter durations in this. I'm making these 1 and 2 year calls, quietly sitting out in the farther, but I even bought some gamma on some of it. But
nice.
But the point, though, is that whether you use the TUA, I'm playing the 2 year, which I also think is a big play. I honestly think that the Fed is going to have to ease more than the market is pricing in. And even if the Fed doesn't end up doing it, the market is highly vulnerable to price in. Once things kind of get rocky, they're going to at some point start pricing in no different what they did in 2023 and 2024, where they're going to start pricing in potentially 5 to 10 rate cuts. And even if the Fed doesn't end up doing it, I think they'll get priced in at some point.
So I completely agree with you there. The only question is, could we get a situation where the more aggressive they assume the Fed is, the harder they sell the long end? Everyone sells long end in scaredness and goes into the short end. So that is ultimately, so you just think, oh, well,
I'm long both. I'm long both.
I know.
So like,
I just,
so
like, that's ultimately my argument, is that from a risk reward perspective, it doesn't make sense to be long the long end. And that's where, and you, like, you would argue, you'd say, well, the reality is most people can't use leverage the same way you can.
Yeah.
And therefore, on an absolute basis, the TLT might outperform, maybe. But, you know, Harley's made this product that, you know, enables you to get leverage with the TUA. There's different ways to play it. I just think if you're playing for a real problem in the stock market or in the economy, that the long end is no longer the play that it used to be.
All right. So we're going to wrap it up with one thing. We're down 111 points. We're 20 points away from the strike.
Spicy, eh?
And it's a 40-cent delta already on those puts.
Yeah.
And
it's moved.
Like, I am going to go.
I see my buddy Lutz is
I'm going to hang up. I'm
Yeah.
going to hang up. I'm going to go put some popcorn in the microwave.
And sit back and watch.
I'm going to sit back and I'm going to watch what happens here, because this is entertaining as fuck.
Well, the other thing is this CoreWeave, they're having trouble pricing it. You know, NVIDIA had to step in and buy it. They still haven't opened it. As we were doing this, it says they're now indicated at 39.25, priced at 40. So what happens? They open this up, you know, they open it at $39 and it's instantly 35. Yeah. That could be a, whoa, fuck moment. Anyways, we're Gucci. It's probably going to rally, you know, way higher, and we're going to look like idiots, but it sure is fun.
That's the way it works.
Yeah. All right. Thanks for tuning into the Market Huddle. Patrick, where can they find out you and your wonderful webinar that you have coming up?
You can find me at bigpicturetrading.com.
Where's your webinar? What day is it again? You might as well.
It's on Tuesday, April 1st. It's not an April Fool's joke. It really is going to happen. It really is going to happen at 4 p.m. I promise.
You should have made it 4:20.
How about you?
They can go check me out at themacrodose.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time on this wild ride. Now stick around for the after show.
You know what? Danny, what do you think? Should we change the start of that webinar to 4:20?
I think that's absolutely perfect. Maybe just be late 20 minutes or something like that.
No, don't do that, because then people are going to be like, do I go for 4? Do I go for 4:20? You already told everyone 4.
Oh, so let me rate this.
Yeah,
I love
the grass. The cut grass.
I am going to go and mow my lawn right now and just chew it. No, that's actually the peach comes out more than the grass, but it's actually I haven't been drinking a lot of beer recently.
Yeah.
But an IPA with this kind of percentage, it's actually fantastic. It's a good beer.
So what's your number?
I'm gonna give it 7.9.
7.9. Solid choice. All right, yeah. Daniel, since Patrick and I have been spouting on and saying stuff, what's new with you, man? Mate?
Well, first of all, Danny, just move your head a little bit over so that sun cuts your face in half.
No.
There you go.
What is going on? Daniel's outside, he told me earlier. Did you stay outside?
No, not now. I decided to try a standing desk outside. So I took my laptop and I took a ledge of a window and popped my laptop there. Game changer.
Yeah, it is nice.
Yeah.
The way the light hits his face. This is for our ladies. Our seven ladies that tune in.
Listen.
All right, Daniel, what do you got new? You got to give us something exciting to talk about. What are you doing this week?
Well, I would like to say, just before we move on from the ladies' comment, that's gone up 3 to 7, so I'm obviously doing something right.
Thanks, buddy.
What's new? Not a lot. Nothing new with me. Just beautiful sun has come back, and that's about it, really. How about you guys?
Like it's the end of the rain season in Portugal. Like so, it's throughout the month of March. It's been miserable in terms of like rain every single day, windy as fuck.
Yeah. One of my buddies just went, he goes to the south of Spain, and he was saying that this last month has been the rainiest in 50 years or something.
Yeah.
Like he thought he was escaping the markets, thought he was going to go have a nice time in Spain, and it ended up being the bad
but this
weather
weekend
just chased him there.
This weekend, 24 degrees, sunny. I'm gonna grab the surfboard and head out for some waves.
Yeah, I was thinking of doing the same thing tomorrow. Hit the beach.
Oh,
Sunday.
you and Puppy. Oh, have you picked up it as well, Daniel?
Well,
you picked up surfing as well.
I'm more of a like doggy style in the water, so not surfing, more just floating. Not really doing much.
Well, I wouldn't necessarily call what I do actually surfing. It's like more falling into the water.
Yeah. Same.
Do you enjoy it? It's a lot of work, right?
Oh my God, it is an extreme sport. Like, and especially like the waves. You're not talking these 1 to 3 foot waves that a lot of people learn on. Right now in the in these kind of winter spring months, they still have these 6 to 8 footers. And so like these things can go crashing down on you and put you into like a proper rinse cycle. It's it's pretty intense.
I wanted last year I was with Cuppy and we were somewhere hot, and he said he looked at where we could go surfing and he says, that looks a little spicy for you. We better not go. So I'm a novice. And I sent a picture of the waves and the way they were breaking into the rocks to my son. And I said, like my buddy's thinking about going out here. If he goes, should I go with him? And the response was, no, Dad, you're going to die if you go into He was just like, no, you are going to die. Cause like the way
he's out in Halifax, right?
Yeah, my son. Yeah. And so
they do surfing out there, right?
Yeah. It's actually, there's some decent surfing.
Absolutely.
Surprisingly. Yeah. It's a big
that's
surf
one
community.
of the few places in Canada that you can go and get a really good surf.
Yeah, and the other one's on the
you
other
have to
coast,
wear
right?
it's like Portugal where you have to wear the wetsuits the whole time because
I
the
feel
water
like
never.
you would need like a wetsuit and then a furry jacket and a bear skin on top.
Well, my son is tough. He actually goes days without a wetsuit, and I'm like, you got to stop that. And then the real problem is that if you go follow the big white sharks, you can see them cruising along, and I'm like, oh, geez, don't go there. Like, there's Bertha is 1,500-pound white shark is cruising around right there. She just came up, in this harbor over here and stuff like that. So it's a little scary that way, but we won't tell his mom.
Yeah, I'm out. Because I'm just bobbing, remember? So I'm just.
Yeah, that's right. Okay, well, we'll call it a day. We're going to go watch the action. Patrick's going to go do his popcorn, and we'll see what's going on.
Yeah, listen, great episode, guys, and
good luck to everyone out there.
Absolutely, and we'll reconvene in a couple weeks.
Yeah, see you guys. Take care.
Thanks, everyone. Cheers.